Thank you very much, Sam. I don't know how I follow that, but I'll do my best. So, let's talk about business taxes, and in particular, employers' national insurance. So one of the announcements yesterday, one of the biggest impact announcements, I think, is the change to the employer national insurance contribution limit. Over the weekend, there was speculation of a 2% increase in the contribution level. In fact, the increase was only 1.2% from 13.8 to 15%. They have also tinkered around with some other rules as well, and they've looked at the threshold at which the contribution starts to be paid. And the threshold now is down from £9,100 to £5,000, which means more employees will fall within the bracket whereby the employer needs to make an employee national insurance contribution on their behalf. They've also tempered that by increasing the employment allowance from £5,000 up to £10,500, which means that smaller employers who will have been most heavily affected by these changes proportionately do have a measure of relief. They've also removed the rule whereby the employment allowance is removed where the national insurance contribution level by the employer exceeds £100,000. So it means all employers now get an employment allowance, whereas until yesterday they didn't. Best way really is to look at an example, isn't it? I've assumed here earnings of £40,000 and I've looked at a small employer for one person, for 10 employees and then for 100 employees. And I've looked there at what the current rates are and what the rates will be after 31st of March next year. What it really means is that currently the single employee company doesn't get an employment allowance, and that still is the case post-April. So a one-person employee doesn't get an employer allowance, but where the £100,000 limit is breached, you will get the employment allowance. What this really means is there is an increase of £1,000 where you have one employee earning £40,000. For 10 employees, it doesn't go up tenfold, it goes up to about £4,300, but for 100 employees, there's a chunky increase there of nearly £90,000. And the effect here is that the overriding percentage limit has gone up from 13.8 to 15%. It's helped by the increase in the employment allowance, regardless of the size, but large employers will be paying much, much more than they were previously. So let's have a look at something else and look at employee ownership trusts. These were first introduced back in 2014, and they are there to encourage founders and shareholders to pass ownership of their companies to employees, fostering a culture of shared success and engagement. And we do have clients in the room today that have gone down this route and actually transferred their business to an employee ownership trust. So in return for doing that, the rate of tax on the gain is down to 0%. So to pass it through to employee ownership trust is a great thing to do from a tax perspective. So EOTs are great for certain businesses in certain circumstances for sure. They can work well where there is a mutual respect and a full understanding of the rules. But what we've seen over the last few years are some avoidance issues that need to be addressed, and they've introduced measures yesterday to do precisely that. So following a period of consultation, these rules really look to make sure that if you use the EOT rules and don't pay tax, you can't control your business going forward in the way that you controlled it prior to giving it to the EOT, and also that you can't expect to receive consideration in excess of market value. And people were pushing the boundaries all the time in trying to do this because of the 0% tax rate. So moving on to the corporate tax roadmap. Now, Labour have unveiled a corporation tax roadmap, which is a good headline concept without doubt. The idea is they're setting out what their intentions are for the duration of the government. So this is a new idea. They claim, and I quote, it delivers what taxpayers told us their priorities are for the corporation tax system. And it goes on to say people want predictability, they want stability, and they want certainty. And the government have also said that they intend to make the corporation tax system as effective as possible. So the first thing to say is that the main rate of corporation tax remains at 25%. There are no changes, and nothing was announced yesterday to change those. Now, if you look back in their last term of government, Labour had corporation tax rates of 30%, and when they finished in 2010, the rate was 28%. So they're used historically to having a much higher rate of tax than the current 25%. They've said the small company profit tax rate of 19% will continue, and they don't intend to make any changes. So that's good. Smaller businesses with profits of up to £50,000 or between £50,000 and £250,000 pay a progressive rate of tax between 19% through to 25%. Furthermore, they made no changes whatsoever to capital allowances yesterday, which was a bit of a shock. We normally have some tinkering along that. And in the roadmap, they've basically said we don't anticipate making any further changes to capital allowances during the duration of this government. They've gone a stage further and said the same about R&D. They're not anticipating to make any changes to our current R&D rules. Our R&D rules are complex, they lack definition, and we could all do with some clarity, but they're not anticipating to make any changes. They've also made further commitments about advance assurances and simplifying and improving the tax administration scheme just to make life easier. There's consultations to follow on that. We don't know timelines, but they're not really making any changes. What will be interesting, I think, in future years is when we come back and stand here, will they actually stand by what they're saying here? Will they actually commit to saying that corporation tax will remain at 25% for the duration of the government? If I were a betting man, I think I know where I would bet. So let's have a look at some vehicles and benefits in kind issues. Very few changes to cars, vans and electric vehicles, but some to mention. The first thing is that there's a further 1-year extension for electric vehicles and charging points, which is part of the government's commitment to get net zero greenhouse gases by 2050. So that means that the 100% first year allowances for electric vehicles continues for a further year. They've announced ongoing increases for company cars through to 2029-30. We already knew the rates up to 27-28, but they've announced 2 further years. Now what this means is an electric vehicle, by the time we get to 29-30, will have a benefit in kind rate of 9% on it. And a vehicle with less than 50 grams per kilometre of CO2 emission will have a benefit in kind of 19%, and the maximum benefit in kind on a gas guzzling type vehicle will be some 39% by 29-30. Now, van benefits increase along in line with CPI of September 2024. There are some rules that I'll mention on the next slide about twin cab pickups. But the final thing on this slide I just want to mention is that from April 2026, the payrolling of benefits in kind through approved software will be mandatory. The reason HMRC seem to have done this is they estimate that some 3 million people would need to be in contact with HMRC if they weren't payrolling those benefits in kind. So I think this is all about efficiencies for HMRC rather than anything else. So, twin cab pickups, announced last year, followed by a spectacular U-turn just hours later, but now we're back to where we were last year. HMRC really don't like twin cab pickups, and the reason they don't like them is they're half van and they're half car. So, the popularity over the years has probably centred around their tax efficiency rather than anything else. So they will, from April 2025, be treated as a car for both benefit in kind purposes and also for capital allowance purposes. Now, for capital allowance purposes, what this means is at the moment, you're likely to get 100% write-off in year 1, which is great from your cash flow perspective. Great to encourage investment, great to keep the new vehicles on the road. Following this change, you will get only 6% or 18% on a residual balance basis going forward, which means it will take you much, much longer to get your tax relief on a twin cab pickup. There will be a much, much higher benefit in kind for the drivers of the twin cab pickups. These are not low emission vehicles, so the percentage chargeable benefit in kind will be high. There are, however, some transitional rules, and those transitional rules mean that they only apply to new vehicles acquired on or after the 1st of April 2025. So there is still time to qualify under the current rules, and the existing treatment of existing vehicles for benefit in kind purposes continue to be treated as a van beyond the 5th of April next year, and in fact they extend right through to the 5th of April 2029 for current vehicles. So, furnished holiday lettings. This was previously announced but confirmed in the budget yesterday, and that is that they will indeed go ahead from next year. What this means is, effectively, furnished holiday lettings have been treated as a trading business for many, many years. They've had tax breaks that go with that, which basically means there's better tax relief for the interest paid, for capital gains tax purposes, for capital allowances and for inheritance tax reliefs. But going forward, they will be treated like any other property income, and they will be treated as an investment business rather than a trading business. These changes take effect from April, so there is still time to take advice, to make some changes, if indeed you are affected. Lucky me, I've got VAT this year to cover as well. The main change in VAT, well, really the only change in VAT, is about school fees. And we knew about this in advance of yesterday, but we were waiting to see whether, in fact, they did include it in the budget. And yes, they did. This is no great surprise. 94% of students are state educated in the UK. HMRC state that they seek to achieve a high quality education and make it available for every child, and that the system is fair with all users of private schools paying their own fair share towards this. So therefore, they're increasing school fees and charging VAT with effect from 1st of January 2025. If you've prepaid prior to the 29th of July, you may not have to pay that, but you need to check and make sure that you're invoiced and paid prior to the 29th of July. If you've paid subsequent to that and the term starts on or after the 1st of January 2025, you will still be liable to the new 20% tax charge. Of course, the schools themselves will be able to claim back VAT on some costs, so it may well be that they don't need to pass the full 20% charge on to the fees, but I think we'll see some will charge the full 20%, some will phase in over a period of time, and anything in between that. So finally, a cauldron of potions and spells really to encourage everybody to stick by the rules and don't push boundaries and pay their tax and pay it on time. So late payment interest is being topped up by an additional 1.5%. So it means it's a penal rate of interest to encourage people to make sure that they pay their tax and they pay it on time. There are anti-avoidance rules on loan to participators in group situations, which create a potential tax charge, and a series of transactions and loans to repay others have now been caught by anti-avoidance rules. And the crypto current asset reporting framework starts from the January 2026. This means that all of those transactions will be reportable and shared both in the UK and much wider. They're also looking to simplify transfer pricing, the permanent establishment rules and the diverted profit tax charges. We don't know what this means. We know simplification historically hasn't really led to that, but let's wait and see. And as ever, they're trying to make sure that the promoters of tax avoidance schemes are properly addressed and caught. They say this every year. This is an ongoing issue. But what is interesting is they've announced 5,000 new jobs for HMRC. They're saying 200 of those will be in post in November 2024. They're saying 1,200 of those 1,800 of those will be in the debt management units to make sure people pay their tax and they're chased to pay them on time. And the remaining 3,200 will be in compliance and inquiry positions, which means that they're trying to attack once more those that are not paying tax at the right level. This is no surprise because the latest tax gap figures, which go back to 22-23, show that nearly 5% of all taxes that are due to HMRC are not actually paid to them. So that's some £39.8 million. As I say, the total tax takes £823 billion. So to collect 5% of that is well worth their while.